All right, let's get started as people continue to trickle in. Welcome to today's webinar, Perspectives from CEOs, Go-to-Market Strategies and Value Creation for 2024, with SBI's Head of Research, Brian Curry, and Senior Partner, Tony Erickson. A few housekeeping items for you. The recording and slides will be available after this session. The Q&A function is also enabled, so if you have any questions, you can ask them there, and the hosts will answer them live. And without further ado, I'll pass it over to you, Brian.
Okay, thanks. Can you hear me?
I can hear you.
Good. All right. Hi, everybody. Welcome. Thanks so much for joining us. Today, we're really excited to be sharing these perspectives that we've been hearing from CEOs on how they're thinking about go-to-market and value creation for 2024, now that we're about a quarter in. We have a ton of information to share with you all today. It's really good. It's interesting stuff. So we're going to dive right into it. I'm Brian Curry. I'm the head of research, as Amy mentioned, here at SBI. I lead the team that put together much of the work that you're going to see today. And I'm joined today by my colleague, Tony Erickson, who will be adding his expertise throughout the session. Tony, you want to say hello, introduce yourself?
Yeah, Brian, since this is live, I actually debated whether or not I wanted to be on mute and act like I was talking to throw the script off. But nonetheless, I'm assuming the mic is working fine, and thrilled to be here with all of our guests today and yourself.
It's working great. Thanks for not messing with me. So okay, Amy's covered the logistical notes. One additional logistical note as we get into it. This session is going to be a little bit different from some of our other sessions, which sometimes get into storytelling in a way. This one is loaded with benchmarks, and we're going to get into the practicalities of what to do with all this information, what to do about all the information. But just setting the stage here, you're going to see a lot of really interesting data today, all about what's on the minds of CEOs and a little bit of what's on the minds of sellers and buyers as well. So let me show you where we're coming from with this on the next screen here. So we have a lot of interactions with senior executives as part of our day-to-day work here at SBI, including, of course, in our research, but also in the work that we do with our clients every day. This webinar is bringing together a bunch of those perspectives. So we're starting from a foundation of our quarterly CEO surveys. Every quarter, we do a 20 or so question survey of CEOs on what they're seeing in the market, how they're feeling about their go-to-market strategies. A few special topics we're hearing might be of interest. So we kind of ask them questions about a lot of different things. And we ask them a lot of the same questions on a quarter-by-quarter basis so that we can see how things trend over time. You can see across the bottom what the group looked like for the most recent survey. So some other C-level executives in there. We're going to get into that a little bit more, where we break out some of the data to see if there are any differences. The group comes mostly from privately backed, but some public companies as well. Annual revenue in the $100 million to $2 billion range, software, business products and services, other B2B industries. So that's where kind of the bulk of the data that we're going to be sharing is coming from. Now, there are other things that we do throughout the year to ensure we have a full understanding of what's going on in the go-to-market space and what's on leaders' mind. That middle box is one way we validate what we're hearing from leaders by going out and asking sellers and buyers what they're doing and what they're experiencing. And we'll bring some of that data to bear in this session as well. And then finally, we talk about this data and other trends we're seeing with our clients all the time, including in regular group sessions with CEOs, with CROs, enablement leaders, all of that to add color and context to the data. And we'll bring some of those conversations into today's session as well. So let's start with a quick overview of the four big themes we're seeing. And this will also form the agenda for the rest of our time. So as CEOs have been thinking about what 2024 will bring for them and for their organizations, these are the trends that appear in the data and conversations we've been having as well. First, they're entering the calendar year with a lot of confidence, and forward indicators are supporting that confidence. Second, they're setting strategies in line with that growth confidence, looking to capture new markets but hesitating a bit on some of their key capabilities. Third, while they like the strategy they've set, they're far less bullish on whether their teams can execute it, at least as they're currently structured and the way that they're currently set up. And finally, the fourth one there, they're expecting some more go-to-market team churn, but they may have a blind spot here in terms of how quickly they can restart demand capture in light of that churn. So like I said, we're going to click deeper into each of these and show you the details that underlies them, how we got to these conclusions, as well as what we see as the questions that leadership teams should be asking and the tactics they should be putting in place to help CEOs deliver on their expectations. So we're going to start with this first one on growth. Because we collect this data fairly regularly, like I mentioned, on a quarterly or so basis, we have the advantage of being able to look at how perspectives shift over time. This is one of the more interesting things we're seeing. Demand sentiment is jumping significantly to levels we haven't seen this in more than 18 months as we've been looking at this data. So the chart showing here the portion of CEOs who characterize demand as accelerating, and that's doubled compared with this time last year, right? The middle stacked bar is this time last year. The stacked bars to the right are now basically. So 27% in that middle stack bar, and then 52% on the right, which is just last month. So a year ago, CEOs were far more likely to say that demand was slowing. 35% were in that category compared with only 15% today. That's the light gray at the top there. Now, I want to put a few caveats up here as we absorb this data. First, we should remember, of course, that this is starting from a lower base. So 73% we're seeing things as flat to declining this time last year. To some extent, it makes sense that the baseline is reset right now as the 2024 calendar year kicks off. There's in a way nowhere to go but up. Second, of course, there's a difference between demand and revenue. We still have to capture that demand. This came out quite a bit in our conversations across the past couple of months. Revenue leaders see the market as still in a kind of wait and see mode. They're seeing optimistic projections from their customers. They're seeing budgeting look the way that they want it to look as they ask people whether the money's in there. But they see caution in customers making investments, and they see smaller commitments coming in from customers. So there's kind of this feeling that sentiment will continue to regularly shift up and down across the year. There's also this question about whether the surging demand is coming from the right places. Some people see the uptick coming from their smallest customers, and it raises questions for them about how do they profitably capture that, because revenue is still revenue. So this caution and really this need to get sharp and skilled at demand capture, it lines up with what we're seeing in our surveying of buyers as well. So let me show you that on the next screen. So the selling environment is different. I don't think this is going to be a surprise to anyone on this call, but demand capture is not straightforward now. It hasn't magically gotten straightforward. So this data is from a survey we just completed of B2B buyers, most of whom in this context, we were asking them about repurchases from existing suppliers. So even in these repurchase decisions, you see here trends that we've all been feeling that complicate deals, right? On the left, buying teams are large, a full dozen individuals in the buying decisions. Important to know that we're actually finding that half of those individuals, half of those 12, are ad hoc members of the buying team. So they're floating in and out, and sometimes sellers don't even really know anything about them, which of course is going to make closing business even harder. And then in the middle, CEOs are in the mix 40% of the time or more. And on the right, almost 80% of the time, the buying group's decision is getting overruled by senior people on the team. So they do all this work, and then almost 80% of the time, someone comes in over them and says, "Well, not right now," or "not at this size," or otherwise alters the deal. So demand capture is not a given, even if the spirits are bullish. Now, luckily, as I mentioned, more granular forward indicators are looking good, with one exception. So that's what I'm showing you now on the screen. And I'm just going to talk about this, and then Tony, I'm going to pull you in. When we look at pipelines, deal volume, deal velocity, deal size, more commercial leaders are telling us that those indicators are looking better than last quarter compared with what we saw a year ago. So that's essentially what the black segments of these stack bars are telling us. For example, right in the middle there, 42% of these leaders say that deal velocity is looking better than last quarter, while only 30% were saying the same thing a year ago. Now, again, in many cases, we're working off of small bases. We may be capturing less fruitful long-term demand, but these are positive indicators of commercial momentum, and they're more widespread than we've seen in a while. The exception, of course, is what's on the right side where renewals are lacking. So fewer are saying their renewals are better now than they were a year ago. More are saying they're worse. Full 20% saying things are looking worse this quarter on the renewals front than they were the previous quarter. So Tony, this is where I'd like to pull you in. We've been hearing from clients that this continues to be a story of reduction in commitments. So customers maybe not completely withdrawing, but reducing the number of licenses, for example. What can you tell us about what you're hearing or seeing on this renewals point? Oh, you muted.
Yeah, Brian, I
You
think
jinxed
this is
yourself at the beginning.
I did. I think this is one of the key challenges that we're seeing right now. If you look back at the data that you were just talking about, we don't have to flip the slides, but Q2 22 to 23 to 24, Q1 of 23, lots of uncertainty going on. And you could debate right now whether there's more or less uncertainty, but it does not feel that different compared to how different Q1 of 23 felt to any time in 22. And, so definitely a rebound that we're seeing in the areas like new demand, new logos, the ability to, drive deals faster than we have been able to in the past. However, the one big issue seems to be during 23, during that time of uncertainty, a lot of people started analyzing whether or not they actually need everything that they were purchasing. So that's why we've highlighted the whole renewals piece here. And if you advance to the next piece, Brian, this is one of those areas where companies we're working with right now and clients that we're talking to, prospects, or even just, people that we've worked with in the past or as we're out there doing research, that they're really leaning into this concept of what do I need to do to structure around this new challenge of, my renewal rates, whether it's increased upsell through volume, whether it's cross-sell through new products. They're all trying to fend off the downsell and the reduction in licenses, the reduction in usage, the reduction of certain products. And if you look at this to orient you on this is what we call the road model, which is retain, opportunistic, acquire, and develop. Now, this is a view of existing clients. It's an illustrated view, of course, but the intent here is to understand white space. So if you look down on the x-axis, it is intended to reflect any client currently spending any amount of money with you. But if you think about that midpoint of the graph there are certain clients that even if they're spending with you today, doesn't mean you should be spending a lot of time to develop them or a lot of time to even retain them, just based on their overall spend and the attractiveness and the potential that they actually have. However, those in that acquire bucket, that's areas where there's significant expansion opportunity, right? Not a lot of current spend, but tons of potential. And what we're seeing far too often is people are trying to be everything to everyone and probably spending a lot of extra time in that area we're going to call the opportunistic quadrant, where not even a lot of potential and a little bit of spend, versus where you should be focusing your time on acquiring people with significant amounts of additional potential and then retaining those in your other two quadrants. You're retaining your develop, maintaining that spend level. So it's all about focus, because one of the challenges that we've seen from the last 3 years of doing this research, Brian, is 22 was immediately following the Great Resignation. It was bringing people back on board, almost, for lack of a better term, throwing bodies at the problem and putting more feet on the street. 23, because of some uncertainty, made us think, how do we get all those people more productive? And 24 is now moving into more of okay, we need to continue to drive productivity with the people that we have in the organization. And to do that, we got to create focus. Focus drives execution. And that goes to that early point that you had made around CEO confidence around executing. And part of it is just clarity of role, clarity of focus, not getting overlap, not having everyone focused on the same thing, defined swim lanes, et cetera. So that's a little bit about where we're kind of going here, which I think the CEOs who took this survey with us highlighted very, very rightly the need to have focused execution.
Yeah, for sure. It's a great point. When we talked about this data with a group of CEOs, the one thing they said was they are more in the details on execution than they've been in a long time, right? Because they see the opportunity there. But to your point, it's all about focus and execution in order to get there, or not, right? So they're in the weeds on metrics, on line by line, right? Everything that normally they wouldn't be. They're looking deep at this stuff. So that's great. Good. And I saw a question come in from David. Feels like there's been fairly widespread increase in pricing in technology areas we're working with around. Is this what you see and doesn't impact renewals? The one thing I'll say, David, and we'll show this in a little bit, but the emphasis on pricing as a lever for value creation is declining in importance in the surveying that we're seeing relative to, say, last year or previously. So I think pricing was maybe a 2023 strategy to get through, and maybe declining a little bit, at least in the data that we're seeing. But in terms of it impacting renewals, I think to Tony's point about reducing commitments, even with the pricing, maybe that part of the pricing is causing the reduction in commitments, right? And then leading to still, just NRR numbers, for example, that are maybe not where companies want to see them. Tony, I don't know if you have additional perspective there.
Yeah, I mean, it's a valid point that David's raising. I mean, clearly pricing is a big lever, but in addition to just a standard price increase that is, associated with most technology, to his point, 1, 2, 3%, there's also typically some sort of a COLA, cost of living adjustment, or some sort of a CPI, consumer price index, associated with it as well. So the net price increase looks much higher because inflation indexes and cost of living and consumer prices are just up across the board. So when you think about the cost of supporting technology for these companies, all those costs have gone up, and that's typically one of the indexes, in addition to just a straight price increase, if you will, that's being applied, and that is causing some concern for sure. But the reality is, it's one of the areas that they're being pushed because tech companies are feeling the pressure that everyone else is feeling, just in terms of the cost to support their business and to support their clients.
All right, so that's the first trend. We've got 4 of them to get through. So I'm going to move us on to the second one. Investing more in capturing new markets despite gaps in confidence. So let's dig into this one a little bit. We're going to start with how CEOs are thinking about value creation more broadly by looking at 2 dimensions of value creation: growth and expense, or investment, I should say. So let's start on the left side of the screen with what we at SBI refer to as the value creation compass. I'm sure many of you have seen this or seen us talk about this in the past. But effectively, you've got 2 axes here. You've got your vertical axis representing your growth rate, from an increasing growth rate in the Northern Hemisphere to a decreasing growth rate. Not necessarily negative growth, but previous year you were 14%, and this year you're at 12%. You're going to be down in that Southern as a decreasing growth rate. And then your horizontal axis is your level of investment within your organization. So are you decreasing investment, or are you increasing investment? And that lands you in one of 4 quadrants. You can be accelerating growth without increasing expense, for example, if you're in the top left, etc. So that's the kind of the orientation. And so we ask leaders regularly to tell us which of these quadrants represent their approach to value creation. And so in this case, it's for the year ahead. Probably not surprising, especially given what we were just talking about with respect to demand. An even higher proportion, so more than 85%, find themselves in that Northern Hemisphere on the value creation compass. 45% would be in the top left, accelerating growth without increasing expense, increasing investment, and 42% would be in the top right, expect to create value by accelerating growth and increasing their investment levels as well. Now you see all the way to the right in the chart here, this jump is coming from a commensurate decline in CEOs who this time last year were just trying to hold on. They were in that quadrant 4, expecting growth rates would slow and managing expenses as tightly as they could as a result. So now, similar to what we saw in the previous section, we're likely seeing some base effects here as well. For so many of us, growth rates were quite low in 2023. So it's going to be much easier to expect that those growth rates are going to increase in the year ahead, the calendar year ahead. What's more interesting to us is this split between the left side and managing expenses tightly, and the right side, increasing expenses. And we don't show it here in this webinar material, but when we ask about where expense increases are going to show up, the top functional areas are all directly growth focused. So I guess not a surprise, right? It's sales, it's product, it's customer operations, it's marketing. Those are the top 4 areas that CEOs tell us they expect to see expenses increase. So the return to growth is critical. But so the next thing we want to see is strategically where CEOs focusing in terms of what they see as critical to driving value creation. So where they might have gaps. So to do this, we look at 11 items that we think of as growth levers, and they tie to each of these value creation quadrants. So let's take a look at how those are getting prioritized here on this screen here. So 30 seconds to orient you just a bit. 11 items across the chart, across the axis here, which are the growth levers I was referencing. So for each one, we're showing you CEO ratings of their criticality to success in 2024. So that's the left part, the lighter blue shaded bar. And then their confidence in their ability to execute. So that's the darker blue bars to the right in each of the pairs. So you see, for example, just looking at criticality, the lighter blue, 3/4 of CEOs are seeing optimizing the go-to-market model, increasing customer retention, and boosting market penetration. That's critical to success. So that's the first, the second, the fourth, going from the left there. And this lines up pretty well with their overall emphasis on growth as a driver of value creation, because you think about those first 5 are really focused on growth in particular. But you see those red dashed boxes there. There we're showing you the biggest gaps. So 3 areas in particular show up for us as areas of concern. So the first one is increasing customer retention and decreasing churn, where at least 13% of CEOs who see it as critical do not express confidence in their ability to execute it on. So this lines up with what we were just talking about when it comes to slowdown in confidence on renewals. It's an important gap, but maybe not as significant, certainly not as big as the next one over. Boosting market penetration or expanding into new markets, right? More than 1/4 of CEOs who see this as critical to success don't have confidence in their ability to execute on it for the year. And then that next one over, similarly, developing and launching new products. There's a gap here for 16% of responding CEOs. And you can see, David, to the point we were making earlier, that third one is the one on pricing and packaging. They're actually, to the extent that that's a priority, probably feeling pretty good. But you see how low it is relative to some of the others in terms of priority. So what this tells us, right, is that as CEOs see demand returning and more deliberately pursue growth strategies in line with that demand, they're uncertain they can execute on the most important aspects of it. Now, there's a really critical thing we want organizations to get ahead of here when it comes to this aspect. So the data also tells us that CEOs are pursuing growth from multiple angles, right? They're capturing more from existing customers, finding new markets for existing products and services, and for at least half of them, also bringing new products into the market. So if you couple this with our earlier recognition of increasing expenses in the broader go-to-market organization, it's a lot of activity and investment in the go-to-market engine for these organizations. And one area where this confluence of activity often gets organizations in a bit of trouble is when the pursuit of growth gets a bit disorganized. And I would just set this up quickly, and Tony, turn it over to you for some additional perspective. One thing we see from buyers is fatigue from all of the individuals they find themselves interacting with on the supplier side. it's the bus, right? The bus that drives to the buyer's facility to discuss the deal, to make the deal. We see it in our data very starkly, right? 70% of buyers on the left side there saying they talk to an overwhelming number of supplier representatives. That might be okay, but 64% on the right also report they find themselves having to repeat themselves more or less every time they speak with one of these different individuals. So that our eagerness to build the machinery to capture demand and drive growth, it can drive customers away from us if we aren't careful. So this might be what the confidence gap is belying for us. It might be something else. Tony, just bringing you back in. How's it playing out in your experience? What can we be thinking about to avoid some of this?
Yeah, so we're seeing a lot of companies right now reassess whether or not they have the right number of personnel to deliver the results that they're expecting. And one of the interesting challenges that, has become apparent with a lot of companies in 2024 or late 23, looking at full year results, is just what we call the CAC ratio, your cost of acquiring a customer. So just for a simple example here, if you take a company that's $900 million in revenue, spending $300 million on their go-to-market, sales, marketing, customer success, et cetera, and they grew from 900 million to $1 billion. Now, this is for a largely recurring business. Could be tech, could be some sort of subscription, could be some sort of business services model, but in a recurring business, not so much a manufacturing business where you're, reselling every time the same amount of things, but think about more of a recurring model. In that case, you're spending $300 million to get $100 million of growth, which is, mathematically a 0.33 cost of acquisition. So benchmark is 0.7 to 0.9. And these are the numbers that people were historically seeing. And kind of going back to the last comment, great resignation, lots of hiring, people putting lots of heads into their system for, their overall go-to-market. And what ends up happening is now we have significantly more cost for our go-to-market function than we're getting yield. And now people are left thinking, okay, I've got two options. I can either become more productive, because if you think about it, if we're running in a 0.3, 0.4, and the benchmark is a 0.7 to 0.9, we're getting half the productivity that we should be getting out of our go-to-market function. So we got two options. We can either reduce the cost of the go-to-market function and align it with the growth that we're actually seeing, or we can make the go-to-market function more productive and get it back up to that 0.6, 0.7 ratio. And reality is, for most companies, it's probably a combination of both. Did we overhire? Did we get ahead? And to the point that this is making, do we have too many people in specialist roles, in overlay roles, in support roles, in handoffs that are causing confusion to our clients? When the reality is, they just want to know who to talk to so that they can solve their problem, and we can be a good partner to them and help them solve that problem. So a couple of things at play here, which, really gets us into our next slide, Brian, which is thinking about org design. And, this is, I'll give you a quick high level here and then turn it back to you. But, there are 6 different types of org structures that a company can deploy when developing a go-to-market strategy. So by definition, stratification, basically think large, medium, small. Small number of, very strategic, high value clients, moving into more of a mid-market, and then moving into a mass market, if you will. Then you've got your more traditional hunter-farmer. People bring it into the door, and then other people serve the client and manage the client thereafter. You got your geo, your typical, Northwest, Southwest, Northeast, Southeast type model. You got persona. Some people might sell to CIOs. Some people might sell to CFOs. Some people might sell to CHROs or VPs of supply chain. Depends on the nature of your product. Then you've got product solution. For companies that have grown through acquisition, going to one of those points earlier, Brian, many CEOs are looking at new products, new offerings, being inquisitive, as well as launching new products organically. Now we've got multiple products. So do we sell products and have SME-based sellers? And then lastly is industry vertical. Do we have a utilities team? Do we have an oil and gas team? Do we have a manufacturing team? Do we have a consumer goods team? So those are the 6 by basic definition. And then we've got the catch-all, which is the most challenging, which is hybrid. And hybrid in and of itself is not a bad thing. The challenge is when you have a hybrid of all 6 of these. And we've worked with numerous companies, Brian, where they've literally got all 6 of these in play at one time. And it creates a very confusing go-to-market motion. And if you're the client on the other side, you're trying to just figure out who you need to be talking to, why you need to be talking to them, how you get the help you need. And kind of going back to our other point, you start questioning the value. You know, if you're constantly being handed off, you start questioning the value, and then you start asking yourself, do I really need this product or service, or can I live without it? Because, you know, it's not as sticky as I once thought it was, because I'm confused as to how to even get the value out of it. So this is where, you know, we kind of took some of these early thoughts here, Brian, and, you know, to your point on, you know, how you go about capturing new markets, how you go about dealing with some of those gaps in confidence. A lot of clients today, it's coming down to how are they being structured? And most importantly, how are they creating alignment? How are they creating well-defined swim lanes, you know, racing models to understand who's doing what, so that we're all coordinated and we're most efficient with our spend.
Yeah, that last thing you just said, right, is really important. Right? It's the structure, and then getting the role clarity within that structure, and then get everyone executing on it. I'm just glad, you know what, you had me scared for a minute, because you started the math quiz, and I was like, oh my God, he's gonna give me an unplanned real-time math quiz.
Well, that's the next one. When we get to the third point, just be ready. There's going to be if train A leaves the station in Colorado Springs at 10:49 a.m. So I'll give you the second part of that equation in the next segment.
All right, I'm going to queue up ChatGPT, so I'm ready to answer.
Excellent.
Okay. All right. 2 down, 2 to go.
Hey, looks like we have a question in here as well.
Thank you. Okay, from Wendy. Given the issue with retention, are you ignoring the amount of persuasion needed to retain existing customers in your example? So is your example of applying sales costs for incremental sales growth? So just yeah, when you think about the customer acquisition costs, there's a lot of stuff that doesn't get captured in just that simple math, isn't there?
Yeah, and it's a great question that Wendy's asking, because depending on the complexity of your company, really dictates whether or not you can truly implement a hunter-farmer model, for example, or whether or not you need someone who manages the whole account and they're kind of the single face to the client. And, you know, it then even varies by size. So we have worked with companies recently, for example, who they're in that stratified model. So that was the first one where we've got large, medium, small, we'll call it. But at the large level, they are full-on account managers, and they cover sorry, I don't mean to be throwing balloons right now. I don't know what that is. AI at its best. So, you know, they're covering both the new and the existing, and they're covering renewals, they're covering expansion, they're covering account management, and kind of running all of the traffic cop, if you will. But as you move down, it becomes virtually impossible to manage hundreds of accounts in both new and existing. So we've seen some companies, as you move down into that mid-market or corporate or, you know, SMB, whatever your company calls it, you start to have more of a true hunter farmer in that model. But as you grow those clients and they move up to that enterprise or strategic level, then you have a single face to the client. Because Wendy's point is a good one. When you look at the actual cost, when we talk about that S&M example, the math thing of 300 million against 900 million, we're talking about not only sales, marketing, but the cost to serve, the cost to manage the account, the cost to do the renewals, the cost to do customer success. So it's all of the go-to-market function associated with serving those clients.
Yeah, absolutely. All right. Good. Thanks for calling that out. All right. So let's move on to the third trend, which is confident in the strategy, but questions about the talent to execute it. And I'm going to start here with a chart that stopped me in my tracks when I first put it together. I thought I was going to see something, but I didn't think it was going to look like this. So if you click down from growth levers, what we were just talking about, things like boosting market penetration, developing, launching new products, you get down next into the capabilities you have as an organization to execute on those levers. So this is something we've been thinking about for a little while now at SBI, and we tested out this initial list with CEOs last month to see how they're thinking about these 8, as I've been talking about them, the 8 rights that make up kind of your go-to-market capabilities. So the left grouping that we have here, those are aspects of the strategy and operating conditions grouped together. So go-to-market strategy, product market fit, operating model, et cetera. And then on the right, you see aspects of commercial talent. And there you have it, right? Well, CEOs see most of these as critical success, right? That's the light blue bar, 80% plus, except for the technology one, which is kind of interesting. The portion who see, on the left side is critical, but don't have it right, that's relatively small, right? The black bars and the blue bars are more or less matching. But it's, when you compare that to the right side, right, those the gaps are pretty significant, right? 2 ways expressing the data on the right, neither of which is pretty. So you could either say that between about 30 and 40%, this is the kind of circle numbers there, of CEOs who see commercial talent as critical to their success, don't think they currently have it right. That's the more positive way of saying of talking about this. The even worse way to say it is that barely half of CEOs feel they have the right skills being exhibited, the right people in roles, the right org design, or people doing the right things within their commercial talent. So one thing that you all might be thinking right now, we've heard this a few times when we showed this with anybody but CEOs, is that, of course, CEOs are going to say that the strategy is it's just the people who aren't executing. So I did everything I was supposed to do. It's just these people can't do it. The strategy is theirs. They must have gotten it right. And Tony, you said this to me the other day. I told you I'd dig deeper. I don't have a chart here, but what I'll tell you is that's half true. So you might remember 30% or so of our responses were from other C-suite leaders, not the CEO. I looked at that, and here's the half that's true when we split out those 2 groups. CEOs are softer graders on themselves. So the stuff on the left side, there's general alignment on criticality, so where the light blue bars are. But while the CEO shows small gaps in terms of confidence there, other C-suite leaders show pretty big gaps, as much as 30%, for example, in product market fit, where the other leaders are far less confident in aspects on the left than CEOs are. But here's where it's half not true, is CEOs are actually more likely to be positive when it comes to the commercial talent on the right than other C-suite executives. So others, their black bars are even lower than what we're seeing here for the whole group. So not by much, but it's a clear difference. It's most stark when it comes to roles in org design. 62% of CEOs think they have that right, and only 43% of other C-suite leaders do. You see that we end up somewhere in the middle with 55. We put those 2 groups together. If you think about that, Tony, right on that last point, when you think about what you were saying about org design a few minutes ago, that could be a flag, right? It could be that one of the few areas of miscalibration between CEOs and commercial leadership teams, something that isn't fully appreciated by CEOs in particular, is how important that org design is to achieving the goals that they set up and driving the growth levers that they're thinking about there. A lot of words, no matter who you ask, CEOs are not. Commercial talent is a big gap. Now, it's not all bad news. I want to show you a positive trend here. Assessments of seller productivity, they're getting somewhat more positive. So somewhat more positive. Nearly half of CEOs now see it as improving. So while they might be uncertain about whether they have the right people, the right commercial talent, whether they're set up correctly, they're seeing things pick up with demand, and they're seeing productivity improve as a result. So Tony, I think this and the data we were just showing, it really speaks to the need to visibility into the commercial organization. But I wanted to get your reactions to what we're seeing here from a commercial talent perspective, as well as your perspective on what are some things that we can be doing about this.
Yeah, so on this, when we talk about seller productivity, it kind of goes, it's a build on that last piece we were talking about, which is many companies right now have seen a decrease in the last year or two in overall productivity. Now, in some cases, it's much higher quotas. In other cases, it's many more reps. In other cases, it's, just less demand. I mean, it could be any one of many things, but the key here is that, the CEO's perspective is that it is starting to improve. And the reality is, when we look at this year over year, kind of to your point on, it's not all bad news, like the positive here is people are starting to ramp. So in 23, we had a lot of people just across the industry due to the, changing of jobs in 21 and 22. 23 was almost a get to know your new company year, coupled with a very challenging macroeconomic environment. Therefore, looking into this year, people are like, my field force is going to be ramped. My go-to-market organization is going to be in place. We're got a strategy that we've now been executing against for, in many cases, several months, if not over a year. And now we're into our rhythm, if you will. Thus, the reason why more people have a perspective that it's going to improve. And, we're seeing a swing here. But to your point, the interesting thing is the fact that we're still thinking over half of the CEOs are still saying flat to declining. That's the challenge. There's still some negative sentiment, but the amount of negative sentiment is greatly down year over year. Hey, wanted to answer a question to what Matt Sloniker is asking. So he's asking about some of the 5, most important skills. And I think we can get into that in just a minute. It's a great example. Brian, I don't know if we want to skip ahead to the, maybe go into the next one around productivity, and then we can answer Matt's question with a bit more detail using the visual on the slide on 17.
Yeah, I'll just skip right over to 17. Yeah.
Yeah, let's do it.
There we go.
So interestingly enough, Matt, and to all of you out there, one of the things that we have been spending a lot of time on is actually starting to understand beyond just stack ranking someone's attainment of quota. What is it that makes a great seller great? We've been receiving that question a lot since COVID, as people were ramping post the Great Resignation and looking to backfill, they were all trying to figure out, how do we emulate what our great talent does? So we worked with a team and we developed a tool, and companies who have worked with us in the past, we've always done some element of this. SBI has been a fan of top grading, a methodology co-written with us and GH Smart, where we actually did a methodology to stack rank A, B, and C players. And the key here is that when you look at that upper right quadrant, those are your top players. So those are the ones who consistently year in, year out overperform. But then also we took a view of competencies and behaviors that also make up seller attributes. So Matt, to your question, we looked at things like negotiation skills, referrals of lead generation, nurturing prospects, objection handling. We looked at all those types of things. I'm seeing some comments that there's some trouble reading this. My apologies for that. Amy, I don't know if there's something you can do on that, but I will continue to talk to it at a high level, and we will circulate these after the fact, so you'll have a bit more ability to see it. So apologies for that. But the key here is that the x-axis is an aggregation of competencies that make up great sellers. And as I mentioned, depending on the role type, whether it's a field seller, an inside seller, a BDR, LDR, channel seller, sales manager, sales executive, we looked at people across between 10 and 12 different competencies, and then each competency has between 10 and 12 different behaviors that we test for. We then correlate those to determine which sellers exhibit the strongest competencies associated with what we know to be the tried and true best practices. So Matt, to your question, the people who are great negotiators, the people who are great at objection handling, the people who are great at generating referrals, the people who are great at nurturing prospects. Those are the types of things that we looked at, and we look for repeatability. And as you would imagine, it varies by certain companies. Some companies are a highly solution-oriented sale. So it takes a very much of a consultative approach to actually do the deal. Others are very high volume. So it's really more about tenacity and follow up and, being quick, if you will, almost managing to an SLA. So depending on your type of organization, this is a tech-enabled way for you to baseline an organization and understand where your organization is today. So that if you think about this from a perspective of what you want to do with this, you want to emulate those people in the upper right, those A players. For your B players, they could be high attainers with low competency scores or low attainers with high competency scores. You want to move them. So you want to move them into your A player, and by fundamentally either improving their territory, improving the conditions that they're working in, or improving their skills. And then lastly, on your C players, that's where you've got tough decisions to make. Some of these people could be very early in their career. And you can also start to look at this by tenure. So you can actually see, hey, does the average person hit full productivity in year 2, 3, 5? Or does it take some people even longer? And you can start to figure out the pulse of your business, if you will. So this is a tech way to actually assess the organization, understand the areas of opportunity, develop individual plans. And, Brian, I think the reason behind this, the reason that we wanted to throw this in there is, it's all about the talent to execute it. I'll go to that bullet that you just had, right? That third bullet is confident about strategy, but the questions are, can we execute? Well, the ability to execute is getting down to the individual level and understanding which individuals exhibit what behaviors, what competencies, and then how do we do more of the ones that have proven to work.
Yep, for sure, Tony. And I just tried to share a different way. So hopefully people want to tell us in the chat whether hopefully that made it a little bit better. But if not, that's about okay. Thanks, David. Glad to know that's better. Okay. Apologies
Whatever
for
that
that.
fancy way you were sharing, did not like that.
Yeah, it didn't like that. It didn't like that other way. So so Tony, can you just say everything you just said again? Now that everyone can
Let
see
me,
it?
if we can just rewind for 5 minutes, then we can just replay it. Now, like the summary here though, Brian, I mean, I know you're, but it is fundamentally understanding where everyone's at today using data. And rather than it just being solely stack ranked based on their performance, which is the Y axis here, it's also looking at their competencies, behaviors, and the skills by which you hire them for. So these are the types of things that you can begin to screen for in your recruiting process. You can begin to train for in your individual coaching sessions, as well as your onboarding programs. And you can start to actually create the culture that works for your company. And as we were mentioning, depending on the type of sale, the type of product, the complexity of your solution, everyone is going to have different competencies that benefit their company. There is no one size fits all.
Tony, do you want to say anything about the time study, or should we just in the interest of time, should we time?
Look, let's advance to that and let's put some because it is definitely a derivative of talent. So again, when we're talking about productivity, right? We're talking about productivity and using that math example where we talked about 33% cost of acquisition. The reality is, how much time are people actually spending selling? The typical benchmark that SBI looks for when we do a time study across an organization is between 65 and 75% of time being spent on productive selling activities. Not surprising to many of you on the phone. We have run these and we have seen numbers in the 30s and the 40%. And rarely do we see people get up above the 70 percentile. And to do this, you have to actually understand everything that people are doing. And the amazing phenomenon about salespeople is when you actually ask them where they're spending their time from a non-productive perspective, they will tell you. They are not shy about telling you how much time they're spending on forecast calls, how much time they're spending looking for materials that help them build a proposal, how much time they're spending managing internal resources or internal politics or internal deal approvals. They will tell you all that information. And the beauty is that as you benchmark that and as you begin to track that over time, you can look for specific areas where you can put initiatives in place to improve that selling time, getting down to granular areas. You can look at the amount of time people are spending on forecast calls. You can look at the amount of time people are spending on deal reviews. And it's just information is power, Brian. That's the
Yeah.
theme here. And when we know that we're dealing with a specific problem, in this example around securing approvals, one of the bars on here, if we're spending too much time securing internal approvals, well, let's figure out how to streamline that through an effective deal desk motion, through effective delegations of authority so that it doesn't have to go all the way to the CFO or CEO for deal approval. So figuring those things out allow you to make your sellers more productive without adding headcount. You add capacity, you add hours, you take all of a sudden someone who has 2,000 hours a year who's got 40% selling time, you get them to benchmark, and you've suddenly added 500 to 600 hours worth of selling time into your model without hiring a person. So you do 2 or 3 of those, all of a sudden you've added a headcount without adding any cost.
Yeah, and it goes back to what you were saying, Tony, that if you think about the data that we were sharing on those big gaps on the talent, I think a lot of that is just visibility, right? Like the answer to some extent for I think a lot of those people was, I don't know, right? I don't know if I have the right people. I don't know if I have the right skills. I don't know if they're spending the time.
Yeah.
And so just getting that visibility into what's going on is half the battle.
No, exactly. So, hey, a couple of questions that I want to make sure we hit on here because we've had some good interaction from the audience here. So, market conditions into talent's performance. This is an area where we'll definitely look at trends over time. So, Terry, to your question there, the intent here is we aggregate this over a period of time, so it's not just a snapshot over 1 year. It's over a multiple period of years, and you can actually filter tenured, medium tenure, new people, and even ramping people and filter them out. So, performance conditions, market conditions, that's a bit of a manual adjustment, if you will. But if you look at it over a period of time, they'll normalize out. Another question that we received is different capabilities for different roles. So the way we have built this, Wendy, to your question, is we've actually got 7 types of roles that we go through this process with. So you've got a field seller, you've got an inside seller, you've got some sort of a development rep, you've got a channel rep, you got a channel manager, a field manager, and then you've got a sales executive, laddering up into the execs in the organization. So those are the 7 types. And for each of them, we develop different competencies, and some of them translate across. So you can start to see things like phone skills when you're looking at your inside sales reps. And then you can start to see how phone skills vary for someone who's in a field role. And you'll start to see how a BDR will have phone skills and ISR will have phone skills, but then in the field, it will be more of a face-to-face and a networking or relationship management skill. So they are specifically, there are some overlap, but mostly different across the competencies for each role based on, what is typically best practice.
All right. And there was another one on from Matt on increases in cycle times, medium within the survey group, and anything on ABM as well year over year. Matt, unfortunately, we don't collect data specifically on those two. And on cycle times, for example, what we asked, just given the variability in companies that we might see and what their natural cycle times might be, is more just how does it look relative to when we're asking individual sellers, we often ask relative to their peers, or within when we look at a company level, let's say relative to previous quarter, right? So just to get an understanding of the trend. So from a benchmarks perspective, not something we're collecting at least regularly. So I don't know if you have additional perspective to add there.
Yeah, I mean, your point's spot on. It's hard to compare cycle time across multiple companies like it is negotiating skills, for example, but we do capture it so that as you run this year over year on a periodic basis, you can show that improvement and you can track it. And then that would be something to, the question that Terry was asking as well, like, that could be one of the macroeconomic things. I mean, last year we saw a situation where our research actually outlined this, and we talked about it last year, where most deals were requiring levels of approval never before seen, getting up to the CEO, even getting up to the board. So last year in aggregate, we saw cycle times increase. Yeah. But, it's really tough to take someone who's got a 30-day average sales cycle compared to someone who's got a 12-month sales cycle and correlate the two. but it is great for companies to get that data and track it over time and see how their talent, and their A, B, and C players have varying cycle times based on their approach to selling and the competencies that they show strength in.
Yeah, and one thing this is making me think of is in our buyer survey. My goodness, I'm risking if Craig Riley's on the line, he's gonna either slap his forehead if I get this wrong. But the interesting thing that we're seeing in that data as we're starting to look at it is that deals are taking longer to close than buyers even expect. Right, so they go in thinking it's going to take 9 months, and it takes them 12 months. And the interesting thing is the deals that don't close take longer than the ones that do. I guess that maybe that's not as much of a surprise, but the more interesting aspect of that is even the buyers are seeing things take longer than they want it to. And that's often because of things going on within their work or own organizations and their.
Yeah. Hey, so Brian, I know we're going to run out of
Yeah.
time here with our audience. A lot of them probably leaving at the top of the hour, at least our live participants. So let's get through this fourth one pretty quick.
Yeah, let's do it. Okay. So there was a question that came up from Craig as well on so what does CEOs see as kind of the obstacles here, what they want to do about it. This fourth trend here, what we're seeing is when CEOs are talking about how they're thinking about the talent problem, the talent challenge and how to address it. What this data kind of says to us is they're kind of like, well, we're not going to not do we're gonna try a little bit of everything, right? Like there's a lot of that dark blue of neither small nor large across things like training and skill development, providing tools and resources, comp plan. But then the ones on the right, which we've highlighted here, they're most likely this is what I call kind of positive churn, and that's where we see the highest frequency of CEOs focused on. They're most likely to say they're going to manage out lower performers and hire in better sellers to solve their commercial productivity challenges. Maybe not a surprise, right? CEOs are looking to upgrade their commercial talent. Tony, is what you were talking about. The downside of people, ramped and sitting in there is maybe they're getting a little comfortable, right? And CEOs see that as having some performance challenges that they can get after. But like we've done with some of these other trends, a little bit of a red flag. And so that's what I'm going to show you here. Again, probably not a surprise, not necessarily news, but there's this hit that comes with seller churn. Sellers need to learn the product, the customer, the process, everything, right? They need to build customer relationships. They need to build pipeline. And what we're seeing here in our data is that this is taking longer in general than it even was a year ago, or at least more people are saying that it's taking longer to get new sellers to productivity than we're seeing previously, right? So as we think about what we can do to accelerate this, the one place we start to think is, yeah, you can improve your onboarding process, but oftentimes it comes down to coaching, right? Getting them up to speed faster. And most sales professionals are telling us that coaching has been lacking. So I'd call the data you see on the screen lukewarm, right? Half are neutral when asked whether they receive regular coaching. Another 7 report that they flat out just don't get it, 7%. Right? And on the right side, only about a quarter telling us that they have seen their organization step things up when it comes to emphasizing skill development. So Tony, we're going to talk about coaching in our next webinar a month from now, but I thought we could give at least a little bit of perspective as we're starting to wind things down here on coaching.
Absolutely. As a bit of a primer here for the next session, when we talk about coaching, do you have a discipline? Do you have a structure? Do you have a methodology around coaching? A lot of places say they are a coaching culture, but when you ask someone how they coach or what the process is to coach, it's all dependent on the quality of the individual and their tenacity and willingness to actually be a great coach versus having something that's more prescriptive, something that managers are trained on, and something that is pervasive and living throughout the organization. So when we talk about a methodology, building out these types of coaching methodologies requires actually answering all the questions, getting it on paper, and then doing it in a consistent way, and then having a cadence associated with it, actually having detail behind each session as to what you're going to accomplish, how you're going to structure a coaching session, and then getting into even individual skill levels. So more to follow on this one. I want to be conscious of time here, but you know, in our next webinar, we'll absolutely be diving into this in a bit more detail, because this is an area everyone should be focused on going into next year's cycle, and how they actually do this to improve ramp time and improve effectiveness of the sellers in the organization.
Yeah, thanks. So, and I just popped up on the screen. You can see in the right there, code. If you just hit that with your phone, you can get right to the registration information for that session, as well as the second one there on the talent map, and then at the bottom there, a report that we put out that gets into some of these trends we were just talking about in more detail. So we're right. I think we're a minute past now. So apologies and gratitude to those of you who stuck with us for the full 60 minutes. You've got our contact information there. Please feel free to reach out to us at any point. Would love to talk with you more about everything you've seen here. And look forward to having you in our next webinar. Any parting words, Tony?
I just put them in the chat. Thanks for everyone joining us today. Look forward to following up with you all.
Thanks, everybody. Have a great rest of the day.
All right. Bye, y'all.